Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Kunal Kapoor, CEO of Morningstar. Kunal, nice to see you.
Thank you for having me.
So, people are probably familiar with Morningstar, generally speaking.
Yeah.
But talk to us about the company and specifically what the business model is at this point.
Well, we're all about empowering investor success. So the foundation of the business and our mission is to ensure that investors of all types can hit their goals. And if you followed Morningstar through time, we started very much with a focus on individual investors, and they remain incredibly important to who we are today. But we also serve financial advisors very materially. We serve institutional investors, asset owners, corporates. And so, Morningstar has its reach across client segments when you look at financial services, but the core is to help them achieve their goals, achieve the things that they set out to do through investing, and then importantly, to do it with an independent voice. I can't stress that enough. Independence is a word that I often see bandied about. We take it seriously. And through our history, it stayed that way. And even today, while we've come a long way since the firm that just collected mutual fund data and did mutual fund ratings and research to one that is comprehensive across the portfolio, one of the common threads is that independence.
So you talk about rating mutual funds, the early core of the business, but talk to us about the business model. So how do you make money off of that? You have funds, there's ETFs. What exactly does the company do to make money?
So the majority of our business is tied up in what I'll call licensing revenue, similar to what Barrons would have in that sense. In fact, I think you probably know this, but Morningstar, one of the first things our founder, Joe Mansueto, did was put an ad in Barron's. That's how the company started to take orders way back in 1984. So there's a good connection in that context. But about, just a bit less than 3/4 of our revenue today is licensing revenue. And that can be our data, it's our research, it's our software. And so that's the bulk of it. And then we have now the 4th largest credit rating agency in the world in Morningstar DBRS. And so that's a growing part of our business. Maybe it's a little more volatile than the subscription business because you're starting at zero essentially every year, based on what issuance looks like. And then we have as well an investment management, business. And in that, there are 2 pieces to it. One is we have one of the 2 largest robo-advisors in the retirement space here in the U.S. And then the other piece of it, which you referenced, is our funds. And essentially, we package our funds into portfolios and make them available for distribution through financial advisors. Right. And so it's exclusively through that channel, as opposed to broadly making them available.
Right. A lot to pick up on there, but before we do that, Kunal, I wanted to ask you about the name of the company and Henry David Thoreau.
Yeah.
Tell us about that.
It's the last line, that he'd written. It's the sun. Yeah, in Walden, the sun is but a morning star, and it's really beautiful actually. And I think it goes to the heart of our independence. I think Thoreau, when you examine his writings and his intent, it was a lot about freedom of spirit and independence. And I think those roots are very much core to us. Also, just hope and the future of what's ahead, the start of the day in that sense. And so I love that message of hope and optimism along with independence that kind of permeates our name.
Yeah, it's kind of a iconoclastic, right? I mean, there are not many other companies would pick up on a name that way, but you guys have been a disruptor and also created a new business really over the decades. That's maybe even a better way to put it. What is the current strategy right now? Where do you want to take the company? You've been CEO, since 2017?
Yeah, about 8 years. So what's not different about our strategy is what I talked about earlier, which is it's about empowering investors. And we win when investors win. And if I go back to even when I started at the company 25 plus years ago, it was a pretty simple time if you were building portfolios. Most people were thinking stocks, bonds, or cash. There were some variants to that, but the financial markets have really grown since then. The types of instruments that are available have expanded. Today, there's a lot going on in private markets, for example, And so Morningstar's goal is that we want to be at the center of helping a individual demystify his or her portfolio. And so that means that from our roots in mutual funds, today we cover basically any security type, and we're trying to provide research and ratings on it. And one of the fastest and most important parts of our business is PitchBook, which serves the PE and VC space. And I kind of bring that up because when you talk about what are some of our biggest initiatives, one of them is that we have all the tools to help investors succeed as they evaluate the convergence of public and private markets. It's a trend that has suddenly caught fire. We've obviously been at work on it for 8+ years at this point, but the reality is I think that's a secular trend that's likely to continue, both because I think there's some good to be had for investors, and partly if I put my old analyst hat on, I think there's likely to be a lot of junk sold to investors, and who better than Morningstar to help investors navigate that. So that's a very big initiative in general. We see personalization as a very big force that is likely to sweep investing, where today you and I largely buy pooled investments. And in the future, you think about if you want to invest in the Morningstar US Market Index, how do you customize it? How do you personalize it? You need to have the data underneath that. And so we're building the tracks, if you will, to allow that personalization train, to run smoothly as the technology starts to become pervasive, so that while you and I might use the Morningstar US Market Index as our starting point to build our portfolio, we might allow our own preferences, our own life situation to start, making some difference in that context. And then the final thing I just quickly add is we also believe that there's a very big opportunity in the credit rating space to provide a better, more transparent solution to issuers and investors. And given the opportunity there, we've been hard at work, continuing, to grow our business in that field.
Right. I want to pick up on that public-private market convergence that you talked about. And you mentioned there's probably or maybe junk out there that's going to be sold or attempted to be sold to retail investors. What is your take generally on this trend, though? Is it a good thing for retail investors?
I would say that yes, but with some caution. And what I mean by that is the reality is so much debt today is issued outside of traditional commercial banks. So much of the equity is held outside the public markets. And so if you're thinking about participation and the ability to earn, good returns over time, it feels like that part of the universe is relevant. And hey, if large endowments have access to it, why can't, smaller advisors and individuals have access as well? Possibly the roadblocks have been things like the tax situation, the fact that they're not as liquid, and also just the minimums are incredibly high. And so some of those things I think are being worked on. You're seeing State Street and Apollo get together and try to launch this ETF in the private credit space, which is trying to do things that have not been done. You're seeing different firms in the asset management space beginning to buy private asset managers to bring in-house, and you have a relationship now, Capital Group and KKR. So I think there are some really good players who are thinking about it, which makes me optimistic. The second part of your question, though, as with all things, sometimes that momentum is a result of past strong returns, which I think is partly the case here. And so I think investors need to be cautious and not have the expectations that returns are going to mimic exactly what they've been over the past 2 decades, because I think the probability of that is lower. And I'd also just say that you have to be cautious about fees, expenses, and liquidity. For a lot of investors, that's going to be something to be mindful of.
You mentioned fees, and I want to go back to mutual funds, that core part of the business, and rating funds. Isn't the whole game, though, Kunal, really just about who has the lowest fees, and therefore shouldn't Vanguard always win these beauty contests?
It's not always the case, but I think low fees in general, it's a good rule that low fees are going to be dominant in terms of the returns they ultimately allow investors to have. So I don't think it's a passive versus active debate, which is where I think you were going. Ironically, even Vanguard's active funds are quite good. And the reason they are is because they're low fee. And so if you parse our data, what you find in the public markets is it's less about is active winning or is passive winning. It's really about low cost is beating the heck out of high cost, including in the active space. And people sort of forget to look at that, but that's fundamentally what's happened. Low cost, active has done very well. There's a reason firms like Capital Group, Dodge & Cox are thriving because they always had lower fees. And they have certainly weathered the turbulence other firms have had to face that fundamentally were higher fee.
All right, so you mentioned active versus passive. Let's pick up on that one. Has that hurt Morningstar? I mean, of course, you guys sort of made your name rating actives.
And calling out high fees.
And calling out high fees. But
Yeah.
passive's become a big thing. It's like, well, what do I need a rating for if the world's all gone passive then?
Well, there's all kinds of passive, first of all. And you just need to look at the explosion in the ETF space to understand that we have a lot of work to do even in that space. But what I'd say to you is, if investors are winning, that means the market is growing for everybody. And the opportunity set is growing for everybody. Ironically, when investors don't win and fewer people are able to create wealth and build generational wealth for their families, you have fewer market participants. And I think firms like ours benefit less. And so because investors are winning, it's been great for Morningstar as well, because they're in better solutions. They're likely to invest longer. They're likely to build wealth. They're likely to want to participate and have an advisor over time. Those are good things. And, we benefit from it in many ways.
Right. And it's interesting because, people saw that perceived it as a threat to your business. In the same way, they also perceived the rise of ETFs as a threat to the business. How have you managed to overcome that?
Well, first of all, if that was the case, then the analysts who we love, who I was one of them, we'd be telling them not to be so independent and going out and advocating for these things. But the reality is, we've done it because we've been independent. I think when you're on the right side of the investor, they have other problems to solve. There's not just one problem to be solved. And certainly what you're referring to is a public market phenomenon. But there are so many other things investors are trying to do, whether that's adding fixed income to a portfolio, now looking at privates, thinking about how to incorporate ETFs. You've also seen the rise of model portfolios. So one big thing that we've had to do is build a database of model portfolios, and now we're offering research and ratings on those as well. And often passive products are rolled into model portfolios, and that's how advisors use them. And so there's no shortage of investor problems that we can help with.
Right, including rating ETFs.
Yeah, absolutely.
Right. Another question people asked about you guys, and I think you've overcome this one as well, is running your own funds, and does that conflict with rating other people's funds?
Yeah, well,
How do you respond to that?
Well, first of all, I used to get a little bit of a chuckle out of it because when people would say that, they obviously didn't know that it was a computer running a formula to do the star rating. Where I think the concern was more legitimate is if we had started writing about our own funds, which we have not opted to do. In fact, we don't even cover ETFs that use Morningstar indexes. And that you can debate about whether that's actually necessary or not, but we've taken that stance. And so I think we're very cautious about how we think about these things. And ultimately, I've been part of so many different discussions on this, but the thing that I kind of come back to is your corporate culture has to be the ultimate test of this. You can have the best rules, the best compliance, all that kind of stuff, but if your people fundamentally don't believe in what you're setting out to do, they won't model and use the behavior that's needed. And I think not only do our leaders model the right kind of behavior when it comes to independence and being super thoughtful about how we think about any conflicts of interest, but because they do that, it gives confidence and makes people act and think the right way, right? And that's the kind of thing that's important. A corporate culture really needs to be the core here, as opposed to just like, here's what's written on a compliance sheet. That will only get you that far, as we've seen time and again.
You have a $15 billion market cap, $2 billion plus in annual revenue. Who are your competitors, Kunal?
Well, we have many of them. and they certainly keep us on their toes. And because we operate in 30 plus countries around the world, it's hard to generalize and kind of answer, that question. So we have many regional competitors, for example. But I think in many ways, there are several firms who I admire, who we also compete against, and we compete in different ways. So certainly in the credit rating space, not surprisingly, we compete against the big three. With our software, it's firms like an S&P Global, a FactSet, that we, run into indexes, MSCI, Russell. But the reality is we work with these firms too, and that's part of the ecosystem today, is you do some things yourself and then you work with others on some other pieces. And so I'd say there's not one good competitor, but probably if I lined it up, we compete in the most verticals with S&P Global.
Mm-hmm. I mentioned you've been CEO since early 2017, and since then the stock is up nearly 400%, which is roughly double the S&P 500. So that's great stuff.
Thank you.
How did you accomplish that?
Well, first of all, sometimes you have to, I think, just step back and realize that sometimes you look smarter than you are, and sometimes you look dumber than you are. And so I try not to get overly excited or overly depressed when things are either feeling really positive or really negative. But most importantly, we've got a great team. We're serving investors in a way that resonates with them. And we've focused on end markets that have secular growth opportunities. They're large addressable markets where we still occupy just a tiny share. And we've been focused on meeting investors' needs and not trying to overcomplicate what we do. So having the core of collecting data that demystifies the portfolio and then putting research and ratings on top of those databases and then allowing investors to consume them either directly from us, through our software, or integrated into other products or their own tools. We've been very flexible about that over time, and that's generally worked to our advantage.
And just for people out there retail investors who use your products, do you have sort of a freemium model to a degree in terms of looking at ratings?
Morningstar.com.
Yeah, Morningstar, but also PitchBook. I mean, you can access some of PitchBook?
Yeah, you can get some of the research. Mm-hmm. A lot of the data is behind.
Right.
Subscription wall, if you will.
I want to ask you about retirement and your thoughts on that, what Americans are doing right and what they're doing wrong, and how you guys play a part in that.
Yeah, so I alluded earlier to the fact that we have one of the two large robos in this space, and I'm really proud of what the team there has done. Retirement is an incredibly important issue from both a personal and a societal perspective, right? If you look at many of the debates today taking place, the roots of that I think are in this belief about what the role of the state is in securing someone's retirement or not. And our model here in the US is that increasingly it's a 401k, and so you need to save, and I think that that's a good thing. And what I think we're doing well is the vehicles in 401ks are low cost. I think they have the right type of diversification. I think employers have done a really good job over time of educating people about them. What we're not doing as well is we're not saving enough. And I think that is ultimately the big debate is how do you help people save more earlier, because compounding is one of the wonders of the world. And if you don't take advantage of it early, it can be an issue later on. In Australia, they say they have a superannuation concept where people are contributing more than 10% of their compensation annually into these super funds. And you've just seen over time how people can accumulate. And I think a model like that here in the US is not a bad one. Because I do think if, in fact, this is the dominant model, we should think about it. Ironically, when people contributed to a pension, no one thought twice about the fact that the money was taken out. But now that it's a 401k situation, the onus is on the individual to put that money in. And honestly, there's a lot of debates about do people do well or not. All those are secondary. If you don't save enough, none of the rest of it matters. You can have the best returns, but if you started with a very low base, it's not going to compound. And so saving is the main thing that I think bedevils the 401k. And when I kind of hear about some of the debates about whether it's the right vehicle or not, I think the point is being missed. The point is how do you get people to save?
Right.
It's a very good vehicle if you do that.
Right. You got to take action. And final question. I know I've raised a bunch of threats, and some of them, you stated a very good case on how you've overcome them, and the proof is maybe in the stock. Latest one is AI.
Yeah.
And I know you guys have an AI tool that you're proud of, but what's to stop someone from just using AI and saying, what's the best mutual fund for me to buy? And isn't that a threat to your business? And how are you looking to overcome that one?
The good news is that they're going to need Morningstar data and research to be able to answer that question. And it turns out that it's not easy to go build those databases and have all that history and have all that perspective. And so models are richer for the content that's put into them. And so probably not be surprising to you that we've worked with and been approached by some of the large providers because they see the value of what it is that we're doing on that front. And so I think very much with any new technology, it's a case of optimism. It's all kinds of opportunity. And for us, the tool you referenced, Mo, is just one part of what we're doing. Within PitchBook, you can go and get summaries of transcripts now. Within Morningstar Direct, you can get your questions answered in a snap of the finger. You think about all the screening you do today to select an investment and click here, click there. It's 8 clicks later before you kind of put in all the things you want and get the answers. Just kind of type it in now, you got your answers. And so I think of AI, among many things, of just making it more friction-free for people to do the tasks that they want, either for us as a company in terms of collecting data, doing research, or for our customers who are using our tools. And so does it change the playing field? Absolutely. But does it narrow it? I don't think so. I think it expands it. And, we're embracing it.
Kunal Kapoor, CEO Morningstar, thank you so much for joining us.
Thank you for having me. I really enjoyed it.
This is At Barrons. I'm Andy Serwer. We'll catch you next time.